Can you see my screen? Hope my screen is visible.
Yes, sir.
Okay, so let's look at some techniques that we can use marginal costing for. Have we done the high-low method?
Yes, sir.
So marginal costing techniques, the first technique that you need to know for your exam is the high-low method, right? Which is used for the separation of what? Fixed from what? Variable costs. So we learned this. Then another technique for this is to learn how to prepare operating statements. That's what we did last week, right? Learning how to prepare profit statements using marginal and absorption costing. But here the focus is on marginal costing or operating statements or preparing standard cost cards, okay, which I believe you know how to do. Then we are going to learn about cost volume profit analysis, right? Cost volume profit analysis or sensitivity analysis, right? Sensitivity analysis. Okay, so here we are going to look at single product CVP or break-even analysis. Okay, then multiple products. Then we look at target profit decisions, and then operating gearing, operating leverage. Okay, so these are things that we have to understand here. Then once we are done with this, we are going to look at limiting factor decisions and then modern approach, which is throughput accounting, right? So throughput accounting is a modern approach, right? A modern costing technique. Okay, I want you to write this down, okay? So these are techniques that we'll be using marginal costing for, okay? But this one is a special case, the last one. But we need to understand these ones before we can do this one effectively. I hope when I speak, you can hear me. Am I audible? I hope I'm audible.
Yes, sir. I don't know for the others, but I'm okay.
Let me get some water. That's right. Please, are you done? Please, are you done? Please, are we done? I want to move, so if you are done, we are done, let me know. Right.
Sir, I am done. I don't know for the others.
So we are going to start with cost volume profit analysis, and this one is the key theme of every management accounting paper. So, what is CVP? CVP stands for cost volume profit analysis, right? And it is used to show how cost and profit change when there's changes in volume of activity. Okay, so how does your cost and profit change when you change the number of units that you sell? Okay, so it is the application of marginal costing concept. And one thing you must understand about CVP is that CVP is sensitivity analysis. You are looking at how a change in one variable or a change in some variables are going to affect your profit, right? How a change in cost and volume will affect profit, how a change in cost and profit will affect, how a change in cost and volume will affect profit, or how a change in your volume will affect cost. It depends, right? So the whole thing is that when it comes to CVP analysis, you are just what? Adjusting some things to see how the effect will be on your profit, right? And this is the most effective management accounting technique we actually use in real life. If you are employed as a management accountant, it is this technique that you will be found using most often. Do you understand? So a typical question that they like to ask you in exam are the assumptions that we use in CVP. They are the same assumptions that we use in marginal costing, right? At ICA level, the assumptions is that when you are doing CVP or break-even analysis, your costs are either fixed or variable cost, right? And we know that variable cost per unit is always constant, right? At all levels of activity. Do you remember? Do you remember this?
Yes, sir.
And we all know that fixed costs are constant in each period, right? These are things that you need to understand. Fixed costs are normally assumed to remain unchanged at all levels of output. That's the next one. We know contribution per unit is also constant per unit, right? Contribution per unit is also constant. Why? Because selling price per unit is constant, variable cost per unit is constant, making contribution per unit constant. The selling price per unit will also be constant, right? Hence, making contribution what? Very constant. Therefore, the contribution to sales ratio would also be a constant value at all levels of sales. Please have this in mind because they can ask you this for 5 marks. Now, if selling price per unit, variable cost per unit, and fixed costs are not affected by volume of activity, sales and profits will be maximized by maximizing your total contribution. So when you maximize profit, then your contribution is maximized. And when you are doing CVP, there's no opening and closing stock. So the amount you produce is the same amount that you sell. If you produce 5,000, you are selling 5,000, no opening and closing stock. So these are the assumptions that you use for CVP. But these assumptions have some limitations, right? Remember that costs cannot be classified into only variable and fixed. Some costs can be mixed, some can be semi-variable, and so on and so forth, right? Selling price for a single product mix may change as economic conditions changes. You know that. So selling price is not always constant because things may change. Tax rates may change, VAT may change, right? Inventory levels may also change. So these assumptions may not always be correct. The level of technology may also change to meet demand conditions, right? Okay, so it can affect these assumptions. There could be multiple range of products with varying degree of cost and revenue assumptions, right? And the assumption that there's only one constant product mix can also be true. And the assumption that volume is the only factor that drives cost can also be true, because there may be other factors that drive cost, like labor and material. And risk and uncertainty is pervasive in any decision making. Regrettably, the assumption also ignores risk and what? Uncertainty. So these are the limitation of these assumptions that we use in CVP. Are we okay? But when it comes to CVP, the most important concept, as I told you in marginal costing, is always what? Contribution. So remember that contribution per unit, we know contribution per unit is constant, right? So what is our contribution per unit? Our contribution per unit is our selling price per unit minus what? Our variable cost per unit, right? So we are looking at per unit per unit. If you want them in total terms, you are looking at what? Per unit per unit. Okay. Now, one thing you must understand is that we learned that under CVP, also, the unit you produced, are you getting it? Are the same as the unit what? Are the same as the unit what sold. Is that not so?
Yes, sir.
So, assuming they tell you that a product, okay, let's use this as a product has the following information, okay? Has the following information: selling price of 100 cedis and variable cost of 40 cedis. And then it has total fixed costs of 150,000. Okay, let's say it has fixed cost of 150,000 cedis. And they're asking you that A, how much or how many units must be sold? Okay, how many units must be sold or produced and sold to break even, right? To break even. Okay, it means that at break even, remember, at break even, profit is equal to fixed cost. A contribution is equal to. So we are saying that break even make what? Zero profit. Okay. How do you make zero profits? Breaking even means if we know that contribution minus fixed cost equals profit. Do you all remember? So if contribution minus fixed cost equals profit, if I want profit to be zero, that means contribution must be equal to fixed cost. True or false? True or false? True or false?
Sir, true.
So we also need the break even in sales revenue. Okay, in sales revenue. So this is what we need. Now that we've been given this information, always when you are giving CVP, always trying to find your contribution per unit, right? This is what we are saying. We know that contribution, right, minus fixed cost equals profit. Is that not what we know? No, so. And we are saying that our contribution should be our contribution per unit times the number of what? Units which we want to find. Also, minus our total fixed cost should give us our profits, which we are looking for. I just want to express something to help you understand CVP. It's just normal equation, right? So from the equation first, let's find our contribution per unit. We know contribution per unit is always what? Constant, right? So what did we get from the question? The selling price was how much?
100.
It was 100 cedis, right? With variable cost of how much?
For
40 cedis, meaning our contribution becomes 60 cedis per what? Per unit, okay? Which we know this is constant, right? Doesn't matter how much you produce. If you multiply by that, you should get your total contribution. Okay, here lies the keys. They are asking for the number of units we want to find, right? So we know that our total contribution, okay, our total contribution, which is what? The 60 cedis times the number of units, let's call it X, right? The number of units should give us our total contribution, right? This one gives us our total contribution. Then we less what from it? What do we deduct from it to get profit? Our fixed cost. And this one, our fixed cost was 150,000 also. So if you deduct it, you should get what? The net profit. And at break even, how much profit do we make? 0, right? So you are saying that, okay, 60 by X should have given us our total contribution. Minus 150 should give us 0. So what minus 150 should give us 0?
150.
150, right? So you are saying that 150,000 minus 150,000 should give us 0, meaning that 60 by X should give us 150, not be so. So we can easily find the number of units to produce to make us this 0 profit, right? Which is the break-even unit. So it means that the break-even unit, which is our X, is simply giving us what? Our fixed costs, not so, which was the 150,000, all over what? Our contribution per what? Our contribution per unit. Do you get the idea? So what we are doing here is that you are just taking what? Your 150,000 over what? Our contribution per unit, which is 60. And how many units should we produce to break even? When you divide, what do you get?
2,500.
Okay. That means this company has what? To produce and sell 2,500 units to make what? To make no profit, right? Or to make 0 profit. So anything below 2,500 will make the company a loss. Do you understand? Because 2,500 is the minimum you can produce, which will give you 0 profit. So if you produce below that, you are going to make a loss, right? So let me just include something that the company has a budget, okay? So budgeted units for this company. This company has budgeted units of, let's say, 12,000 units, okay? It means that this is the maximum number of units this company can produce, right? The maximum number of units this company can what? Can produce to make maximum profits, okay? So this is how you do break even. So if they're asking you for break even in sales, how do you get it? At what sales revenue will we break even? All you have to do is just take what? Your break even units, which we have, by the selling price per unit, right? And how much was selling price per unit? How many units do we produce to break even? 2,500, not so.
500. Yes, sir.
Each of them cost 100 cedis, right? Selling price. So that means that we must have sales revenue of 25,000, not so.
Yes.
Is it 250? Sorry, 250,000, not so. Sales revenue of 250,000 to break even. Okay. So this is how you get your break even in sales. Because we want to know how much sales we must sell to help us make profit of 0. Okay. So that is it. We have an alternative. Okay. We have an alternative, and that alternative is the use of the contribution margin ratio. Okay, we can call it the contribution to sales ratio, okay, which is your contribution over sales. Or we can also call it contribution margin ratio, okay? If you go to the exam, whichever one is the same as your CS ratio. Now, we can also use the CS ratio to get our break even in sales, okay, or in value. And what we do is that we take the fixed cost. You see the break even was just fixed cost over contribution. Here we take the fixed cost over our CS ratio. Okay. And we'll still get this same 250,000. So let's get our CS ratio, contribution over sales. We know that our contribution was what? 60 cedis per unit, right? Do you all agree? And then our sales was what? 100 cedis per unit. So what becomes our CS ratio? 0.6, right? Okay. Please, if it's a perfect decimal like this, use it. But if you go and get 0.6234517, you get something like this, right? If it doesn't end, then it is better you keep it as a fraction. What did I say? What did I say? What did I say?
Sir, you were saying if we get a perfect decimal, we can leave it like that. But if we don't get a perfect decimal, we should leave it as a fraction.
Yes, use the fraction rather. Otherwise, your figures are going to change. Okay. Do you get what I'm trying to say? Is it understood? So anytime you want break even in sales, you can just find anytime they ask you something in revenue or in sales, all you have to do is just divide by CS ratio. If they ask you in units, just divide by the contribution per unit. Okay. So based on what I gave you there, if I want the break even in sales, I can still do the same thing again, right? Can still do the same thing, but now I'll just take the fixed cost, which was the 150,000, and divide by what? The 0.6 CS ratio. And I'll still come and get the same 250,000 cedis as the break-even in sales units. Are we okay? This is just basic CVP, right? So I'm going to give you a list of formulas, right? But I already explained how the formulas have been gotten, right? And you can always use this. However, if you forget the formula, you can always assume the number of units to be X and use it in mathematical way. You always get the missing figure, right? So if the question asks you for break-even units, right? It is the fixed cost over your contribution per what? Per unit. And you know why it is like that, right? We are trying to find X. Now, if they ask you for break-even in revenue or in sales revenue, right? Just take the same fixed cost and divide by your CS ratio, okay? Are we okay? And everything we are doing here is before tax, okay? Everything we are doing here is before tax. I'll come and explain where the situation is after tax. Now, the next thing is when they ask you of something called margin of safety. Margin of safety is the period or the range for which you are safe in making profits, right? Your margin of safety can be gotten as either in units, okay? Margin of safety can be gotten in units, which means take your budgeted units, okay? Get your budget units minus your break-even what? Units. And that is the period for which you can make profit or the range for which you can make profit. So you realize that with what we said, I told you the company has a total of 12,000 units in its budget, right? But when it produces 2.5, the 2.5 is when it makes zero profit. So you have between 12,000 to 2,500 units, right? Which is the range where you can make all your profits. Anything below the 2.5, you make losses. If you want margin of safety as a percentage, just take the same thing you have at the top, your budgeted units, okay, minus your break-even what? Minus your break-even units all over your budgeted units, right? Times 100, okay? This one will give it to you as a percentage. If you do not have it in units, you can use the sales. You can replace the unit with sales if sales was given. You still end up with the same thing. And it tells you within what range the company can make what? Profits, okay? So using margin of safety, the maximum profit a company can make, okay, the maximum profit a company can make is simply your margin of safety times your contribution per unit, okay, which is the maximum profit. And your maximum profit is always your budgeted profit, right? So that we'll use the same illustration we did to check this out. Okay, I'm giving you formulas that people least expect, okay? Okay. So if you go and they ask you number of units to make a target profit. Okay, you're going to ask you a number of units you must what? Sell produce and sell to make a target profit. All you have to do is take what? Here it is actually fixed cost plus 0 profit because we want to make, that's why we just make a fixed cost. But in actual sense, always you take your fixed cost plus the target profit you want to make, right? And then divide by the contribution per unit, right? So you see, it's just the same thing. If you want units, it's always fixed cost plus your profit over contribution per unit. But if you want revenue, you divide by CS ratio. So this one too, if I want number of units to make some particular revenue, instead of dividing by contribution per unit, I divide by the CS ratio. Do you guys get it? Do you get it? Are you putting it down? Are you putting it down?
Yes, sir.
Okay. So if you are done, then we move to the other aspect. Then we take a simple question. Please, are you there?
Yes, sir.
Okay. Now, the next thing I want to talk about is where they give you after tax. So let's say they ask you number of, maybe find the number of units to make an after tax profit. Okay. Number of units to make an after tax profit. All you have to do is take what? Your fixed cost plus the target profit you expect to make, right? And divide it by 1 minus the tax rate. Okay, so this one is just the target profit over 1 minus the tax rate all over our contribution per unit. And the reason why we are dividing by 1 minus the tax rate is so that we can find the original 100% profits without the tax, right? Remember that I told you anytime something is 80% capacity and they tell you to find 100%, you can just take 100 and divide by what, 0.8. Do you remember? And then you are going to get 100% capacity. It's the same principle here. So if you have 25% tax, then you just divide by 0.75 to come and get the original 100%. That's the amount before tax, right? So anytime you see after tax profit, just take the profit you want to make over 1 minus the tax rate. That is when add it to the fixed cost, okay? Number, if they ask you what sales revenue after tax, right? Let's say, what sales revenue can we generate after tax profit, right? What sales revenue can we generate after tax profit? It's still the fixed cost plus what? Your target profit all over what? 1 minus what? 1 minus the tax rate. But here, what are we going to divide by? Are we going to divide by contribution per unit or CS ratio?
Yes.
Contribution per unit or CS ratio?
CS.
Yes, sir.
CS ratio. Remember, I told you that anytime you are looking for sales revenue, you just divide by what? CS ratio. That is the rule, right? Okay. So put this one down. This, when you go after tax, I'm giving you all the necessary formulas you can expect, right? And then we come to leverage. Leverage, or what we call gearing, right? That tells you how effectively you use fixed cost in your business. So first, I'm going to talk about what we call the degree of operating leverage, okay? Your degree of operating leverage. And the degree of operating leverage is simply how you utilize. So we have it in a single period, okay? You can have this in a single period where you have what? How you utilize your fixed costs to make profit, right? So you are saying that your degree of operating leverage can be given as your contribution over your profit, right? You can get it as your contribution over your profit. And this tells you how profitable your product is, okay? It can also be given as contribution over fixed cost, okay? It can be given in many ways, okay? Or this can be given as contribution over fixed cost, okay? If you want to look at this one, if you use this one and it is greater than 1, it means the product is profitable, okay? If it is less than 1, it means that the product is loss-making. Okay, there are many ways we calculate operating GRE, right? Now, this is a simple methodology of getting operating GRE, which is your contribution over your profit, okay? And this tells us that assuming fixed costs were fixed, right? By how much must sales change for you to make maximum profit, right? That is what operating leverage means, taking advantage of fixed costs in your business to still make profit. Okay, so whichever way you go, your examiner will mark it for you. But when you go with this one, then you can easily see whether a product is loss-making or a product is profit-making. Because if your contribution is more than your fixed cost, that means it's greater than 1, you are going to make profits. But if your contribution is less than your fixed cost, you are going to make loss, right? This is what this implies, okay? And even you can do fixed cost over variable cost or variable cost over fixed cost. It is operating leverage. Yes, boss.
Yeah, please. I want to know what about if is equal to 1? Will it
Then that
break even or
break even. If it's exactly equal to 1, it means that your fixed cost is equal to your contribution.
okay?
Yes. So that means that product is neither profitable nor loss-making. Do you understand? Is it clear to everyone? So that is the degree of operating leverage in the short term. Now, when it's multiple period, right? They give you more than 2 periods and they ask you to find degree of operating leverage, okay? You can get degree of operating leverage as a change, okay? A change in your earnings before interest and tax, or a change in your operating profit, okay? A change in your operating profit over a change in sales, over a change in sales. And what does that mean? You are looking at a percentage change in what? Operating profit over a percentage change in sales. And it tells us by how much must sales change to result in a percentage change in your operating profit, right? So this is your degree of operating leverage if it's 2 or more periods. This is how you go about it. Or if you do not have operating profit, then you can use contribution. So you can do what? How a percentage change in what? Your contribution over the 2 years, I get it, results in what? Resulted from a percentage change in what? In sales. By how much must sales change to result in a greater change in your contribution? Okay, this degree of operating leverage. So these are the maximum formulas that they can ask from any question. The rest is all adjustment to suit you. Have you put all the formulas down? If you have, let's take some questions and then you get used to. CVP is management accounting, right? But I'm giving you the shortest approach to deal with CVP. After that, we'll look at how to deal with multiple products, and then we are going to look at how to deal with limiting factor decisions. Where are you? So that I scroll down and then you write and we start taking questions.
I think it's okay. Please go up a bit.
Yeah.
Yes, it's okay. It's okay. Yes, sir. Thank you.
But have you written the single product one?
Yes, please.
Okay. So put it down. Please, is everyone done now? Is everyone done?
Sir, I'm done. I don't know if the others are done. I don't know. They are not speaking.
So let's take question 1. Question 1 says, well, consider the following results for a volume of 6,000 units. Now, one thing you must understand is what we learned in marginal costing is that even if the number of units are given, right? That means everything here was for 6,000 units. Do you all agree? Is that not what it implies? Since
Yes, sir.
there is for 6,000 units, I told you that marginal costing is all about our contribution. So the first thing I have to do is to find my contribution per unit. And how do I find contribution per unit? I can decide to what? Find everything there per unit, right? And then I can use it to get my contribution or find my total contribution, just divide by the number of units. So what was contribution in the question? Contribution for 6,000 units, right? Gave us what? Selling price of what? 120,000 minus 72,000, right? That results
Yes, sir.
in of what?
48.
40,000, okay. But now everything is about contribution per what? Per unit. So we can just take our 48,000 and just divide by the number of units, which was what? 6,000. And what becomes our contribution per unit? 6,848. So that means our contribution per unit is what? 8 cedis per unit. Okay, that is done. And they said we should calculate our contribution margin per unit, which we have done, right? And they said we should calculate our contribution margin ratio. Our contribution margin ratio. That means we need selling price per unit, right? So what is our selling price per unit? That means let's get our sales, not so, over the number of units, true or false? And sales was what? 120,000. Divide by the number of units, which was what? 6,000 also. So what's our selling price per unit?
20.
20. Okay. So in that case, our CS ratio will now be what? We know this our contribution all over our selling price, right? Contribution was 8 cedis divided by what? 20 cedis. So what's our contribution to sales ratio?
0.4.
Is it 0.4 exactly?
Yes, sir.
Okay, so we don't have to use a fraction, right? So we know this is 0.4. Okay. The next question is what? How many units should we produce to break even, right? How do we get break even in units? Give me the formula. Break even in units is what?
Fixed cost
We
over
take our fixed costs
contribution per unit.
over our contribution per unit. Contribution per unit, okay? And in the question, how much was fixed cost? Fixed cost was
40,000.
cedis divided by our contribution per unit, which is 8 cedis per unit, right? And that gives us what?
5,000.
5,000, right? Okay. So always, I told you management accounting is always about commentary, right? So the company must what? Produce what? 5,000 units to break what? Produce and sell 5,000 units to break what? To break even. No, so that means at 5,000 units, we are not going to make any profit, okay? So they are asking for break even in sales. How do we get break even in sales?
Fixed cost over CS.
Okay,
CS version.
so we can take our fixed costs and divide this by what? Our CS what? Ratio? No, so. Or just multiply this 5,000 units by the selling price of what? 20, no, so. And 5 2, that's 100,000 also. Okay, let's see if truly we get the same thing. Fixed cost was 40,000, CS ratio was 0.4. You see, we still get the same 100,000, right?
Yeah.
Yeah. Are you gradually getting it? Is this thing difficult? Okay, the next question is 5, margin of safety. How do we get margin of safety?
So they are not allowing us to write scroll.
Yeah, I'll allow you to write after. Because we are going to solve many questions around this till you become fluid with it. This question, there is nothing, it's just something, right? How do we get margin of safety?
So which one is it unit or?
In units.
It's budgeted
budgeted
units minus break even units.
Yeah, so we take our budgeted units minus our break-even units, right? Okay. So we are saying that, what was our budgeted unit? In the question, they had already done their budget, right? Everything was based on the budget. So now give me, what does it become? What does it become?
That's 6,000.
6,000 units minus break-even units was how many?
5,000.
Break-even. 5,000 units. So it means that the margin of safety is what?
1,000 units.
1,000 units. It means that the company unit should not fall by more than 1,000, right? Otherwise, they are going to make loss. So this is what it means. If I should put this in a diagram like this, right? Where we know this is what? This is the number of units produced, right? And the maximum number of units here is 6,000, right? And the minimum number of units that make a loss is 5,000. No be so. Do you all follow?
Yeah.
The maximum profit that can be made for this company is 8,000 here. And the lowest is 0 at the 5,000, right? The highest here is what? Is at 6,000. No, so, and the lowest is at 5,000 here, right? Now look at something that happens here. Anytime the number of units between 5,000 and 6,000 is not 1,000 units, and anything that falls below the 5,000 is loss making. So everything here is a loss. True or false? And everything here is what? It's a profit. Do you all agree? So look at something here. Immediately the company produces, let's say, 4,990 units. That means the company's unit has fell from 6,000 to something less, more than 1,000. Would it make a loss or it will make a gain?
A loss.
A loss, because it has fallen by 1,010 units, right? From 6,000, it has fallen by 1,010 units. So it will make a loss. So that means this is the period, the number of units for which you are safe, right, to make profit. If you fall below this, you start making losses. And we can see that as it produces 4,990 is less than this, meaning that you are falling by more than 1,000, right? Meaning you fell from the budget by 1,010 units and you start making losses. I hope you now get what margin of safety means. That means that during this period, right? During this level, from the 5,000 to the 6,000, the company can make its maximum profits. So we said that the maximum profit this company can make is just to take your margin of safety and just multiply by what? Your contribution per unit. And let's see if we got the maximum profit. The contribution per unit was what? Was it not 8 cedis?
8 cedis.
And the margin of safety, was it not 1,000? If you multiply, don't you get 8,000? Which is still the same as the maximum budgeted profit. Check the statement. Was the budgeted profit still not 8,000?
Yeah.
Yes. Because that is the safest point for which you can make your maximum profit. And you can see that that 8,000 is the same 8,000 here. This technique is very important. If you know it, you are a senior at management accounting. It's only a few people who really, really understand CVP. They just learn formulas. But if you understand the notion behind it, you can save companies when they are falling. Okay, when you are costing for your own product, you can know when and how you can tweak this or change that to affect this and that. I hope that makes sense.
Yes, sir.
Okay, so how do we interpret the margin of safety? We say what? The company's units must be kept, also be kept within what? 1,000 units, and also to make what? 1,000 units from its what? Break-even point to keep making what? Profits. Or the company's units must not fall by 1,000 units, right? To make losses. If you want margin of safety in percentage, what does it become? We can just take our 6,000 minus the 5,000, right? All over the 6,000 times 100, not so, to tell us by how much that is. Clear? I hope that makes sense.
Yes, sir.
That gives us what? 16.67%. Not so. Which tells us that the company's unit must fall by 16.67%.
Yes, sir.
To what? To break even. But if it falls more than that, it's going to start making losses. Makes sense? Very simple question, right? This question, I don't need you to write it, right? I don't need you to write it. So margin of safety, you can also calculate it using the sales. So you can take your current sales minus your break-even sales. You get it in units, in sales revenue. It doesn't really matter. Okay, so let's look at this question. This one, I'll let you write it. So they are telling us that what? A company makes a single product with selling price of 10 cedis and marginal cost of 6 cedis. And fixed costs are 60,000 per annum. So what is the first thing that should come to your mind? I told you anytime you get marginal costing, what's the first thing that should come to mind? What's the most important concept in marginal costing?
Unit price.
No.
Find a unit. Oh.
No. What is the important concept?
The contribution per unit.
Contribution per unit.
Always, it should be in your head. Contribution, no matter what you are doing, immediately you go to the exam hall, everything in your mind should be contribution, because that is what you need to do every question that involves decision making. You remember? So immediately I go, I need a way to find contribution per unit. Even if things are given in total, I need a way to get contribution per unit. So the first thing I'll do is try to find what? My contribution what? Per unit. And contribution per unit is always given as my selling price per unit minus what? My variable cost per unit. And in this question, given a selling price to be 10 cedis, variable cost to be what? 6 cedis, making my contribution per unit to be 4 cedis per what?
Unit.
So they've given us fixed cost as well, right? So I lay down all my variables. Then I say fixed costs Never divide fixed costs because marginal cost. And remember, I told you fixed costs are always what? Period costs. So it's for each period. So everything is laid down. The very first question says we should find what? Number of units.
Number of units to break even.
So break even in units. And that gives us what?
A fixed cost over the contribution per unit.
Yeah, so we just get our fixed costs over our contribution per unit, right? Fixed costs were 60,000. Contribution per unit was what? 4 cedis per unit, right?
Yeah.
Okay, so that gives us what?
15,000
15,000 what?
units.
Units, right? So the company must produce 15,000 units to break even, right? We are there. Next question. What does it say? Sales as break even
Sales.
units, right? So we need break even what? Break even sales. And break even sales, we know is what? Our fixed cost over what? Our CS ratio, not so? So anytime one sales, is it not CS ratio? So what becomes our CS ratio? We know this our contribution per unit over our selling price per unit, right? Or our contribution of over selling price. Contribution was 4 cedis. Selling price was 10 cedis. Is it not 0.4?
0.2.
Okay. So what's our break-even sales? Break-even in sales. That gives us what? Our fixed cost of 60,000, not so.
60,000 over 0.4.
Over 0.4. And that gives us how much?
150,000.
150,000
50,000.
becomes this. How much they need to sell to break even. Okay. If you think you are not sure, test it and see. See, if sales is equal to 150,000, right? Variable cost was what? Variable cost was 6 cedis times the same number of units, which was 15,000. 6 by 15 is going to give us what? 90,000, right? You end up with contribution of how much? 60,000, not so. Fixed costs, also 60,000. You see that our sales of 150, profit becomes what? Is it not nil? So what we did, is it true? Does it hold true?
Yeah.
Yeah, it holds true. That's why they are saying sales are
It
break.
does.
It means that when you sell that 150, you are still going to make a profit of what? 0. That's why we say sales are breaking. Makes sense. Okay, the next question is contribution to sales ratio. We've already done it. Now, the next question is what number of units is to be sold to achieve a target profit of 20,000? Can we do that?
Yes.
So, number of units to make profit, right? What's the formula?
Fixed cost plus target profit.
Okay, our fixed cost plus the target profit we expect to make, and also all over what? All over our contribution per unit, right? Because here we want unit. Anytime it is unit, you divide by contribution. Anytime it's sales, you divide by CS ratio, right? So in that case, what do we get then? Fixed cost was 60,000. Target profit was what? 20,000 also. Divided by our contribution per unit, which was 4 cedis per unit. Do you remember?
Yeah.
So it means that we end up with what? 80,000 all over 4. That gives us what?
20,000.
Okay, that means the company must produce 20,000 units to make a profit of what? 20,000. You want us to test and see? Let's test and see. So we know our contribution is what? 4 cedis. So 4 cedis by the 20,000 units is going to give us what? 80,000 also. Okay. Now let's our fixed cost. Fixed cost was 60,000. And truly, to what's the profit we end up making?
20,000.
80,000. So what we said, is it true?
Yeah.
Yeah, it is true, right? So this thing is all about testing, but you don't really need to test. But if you think you are not sure, you can test and see, right? Like I did. Okay, the next question was what? What sales will achieve that 20,000 profit? So sales to achieve 20,000 cedis profit. Sales to achieve a profit will be what? Fixed cost plus
Fixed cost over CS ratio.
fixed cost plus the target profit, not so.
Yes, sir.
Yes, ratio. Okay, so in that case, fixed cost was 60,000, target profit of 20,000, all over CS ratio of 0.4, right?
0.4.
Okay. 80,000 divided by 0.4. That means we must 200,000 cedis, right? To generate that. Okay. So at 200,000 cedis, we are going to generate a profit of 20,000. You can test and see, right? Okay. So this is the fifth one. Now the sixth one is saying something that if variable cost, so this one is a sensitivity analysis, right? It's an adjustment. If variable cost increases to 6 cedis, 50 pesos, and fixed costs, are you getting it? This is the type we normally give to you in exam. And fixed cost is now 70,000, right? What number of units will give you a profit of what? 20,000. And anytime there's a change, right? There's a change in a variable. Check how that change in the variable affects your contribution. Will contribution be affected in this case?
Yeah.
Contribution be affected. Why will contribution be affected? Because variable cost has been affected, right? But when fixed cost change from 60 to 70, it doesn't affect contribution. Because this variable cost has changed, contribution will be affected, right? So this is a target profit decision. This is what we call target profit decision. So what is the new contribution? What then becomes our new contribution? Our new contribution
10
becomes what?
minus
10 cedis
10,
minus what? 6 cedis
6.5.
pesos, right? Okay, that's the new contribution. And that gives us what? 10 minus 6.5.
3.5.
That means our new contribution is 3 cedis, what? 50 pesos per
50%.
per unit, and also, okay, then we also need our new fixed cost, right? Our new fixed cost is now what? 70,000 cedis, and also, okay, so that is said and done. Okay. Is that okay? So they said number of units to what? Number of units to make what? 20,000 what? Profit, right? And we know this is the new fixed cost plus what? Our target profit all over what? Our contribution per unit, and also. So we know that this is 70,000. Want to make profit of 20,000, not so. So divided by what? Contribution per unit, which is what? Our new
0.5.
contribution, 3.5, right? Per unit. Okay. So that will give us 90,000 over what? Over 3.5. And how many units? Assuming this decision is taken, is it a good decision or not compared to the existing one? That means we have to produce 25,714 units to still make a profit of what? The same 20,000. But before, we only needed to produce what? 20,000 units to make the same profits, right? So it means that this decision is not a good one, assuming we have different options to choose from. And that's the kind of questions you'll be getting, right? They'll tell you that if you choose method A, or if you choose method B or method C, which one should you continue doing, or which one should you pursue to achieve a profit of this, right? That's the type of questions that they give to you in exam. After this example, we look at those type of questions, right? About 2 solid ones before we look at the multiple products. I hope that was understood. So let's look at the last question. So that was 6. But you see, CVP is not difficult. Is it difficult? Have I simplified it for you? Have I simplified it enough for you?
Yes.
Okay. Now they are saying that if tax is 40%, how many units will need to make an after-tax profit of 20,000? So we are saying that I told you anytime there's tax, right? So units to make after-tax profit, right? Units to make after-tax profit of what? Of 20,000. What did we say about that? You need to make after-tax profit. We said, well, take your fixed costs plus what? Our target profit over 1 minus what? The tax rate, right? All over our contribution per unit. But if we want sales, we divide by CS ratio. So here, please don't go with this new fixed cost. So this one was just an estimate that they were doing, right? You just continue with the original because they haven't told you this will change. So our original fixed cost was 60,000, right? Target profit we want to make is still 20,000. But this 20,000, I'm going to divide by 1 minus the tax rate of 40%, right? Before I now divide by my contribution of what? And contribution was what? 4 cedis per unit, right? Do you remember? Do you remember it was 4 cedis per unit? Don't go and use the 3.5. That one was just an experiment they were doing. So you maintain the original. So this one gives us 60,000 plus 20,000 over 0.6. So that gives us 93,333 over 4 cedis per unit. So that means we must produce 23,333 to make after tax profits of what? 20,000. Does that make sense? Does that make sense?
Yes, sir.
Yes, sir.
Well understood. Okay. So do you want to copy the solutions now? Should I give you room to copy or it's straightforward. We can start another question.
Yes, let's start another question. I think we've taken screenshots. I have taken screenshots.
So you see, with these ones that we saw, they were all for single products, right? What if a company is selling multiple products? That means we cannot use this. Do you know why? Because there will be a different product mix. You must mix both products, right? Do you know that when I sell Pepsodent and then toothpaste, I'll mix them. Maybe if I sell 2 toothpaste, I give you 1 brush. Or if I sell 5 toothpaste, I sell 3 brush, right? There'll be a mix of the product. So it is not, you cannot use this one directly to get it because there's a definite mix or there's a mix of the products that you are selling, right? Or there's an expected output. Because of that, product mixes, right? Because of those product mixes, it becomes difficult to just use the same approach, right? So what we do is that we get a weighted average contribution because we are selling multiple products, right? So when it comes to multi-product CVP, I'll give you a simple, very simple approach, right? So when it comes to multiple product CVP, okay, I'll give you 2 approaches in case you go in the data given. So I'll give you method 1. Method 1 is where you use the weighted contribution, right? Where you use the weighted contribution. Okay. Now, for this question that we're doing, let's find the degree of operating leverage to see if the product is a profitable one. I told you degree of operating leverage, we can calculate it as contribution over what? Over fixed cost, right? Do you remember? And I told you that when your degree of operating leverage is more than 1, the product is profitable, right? If it's less than 1, then the product is what? Loss-making. Do you remember? From the case, what would be our maximum contribution? What would be our maximum contribution? Okay, this one, they didn't give us our budget, but assuming the budget was 20,000 units, right? The contribution would have given us what? 4 by 20,000, that's about 80,000, right? Divided by fixed cost of 60,000. And that gives us what? 80,000 over 60,000, that is what?
12.3.
Right? So this product that's what? Profitable, right? Because you can leverage fixed costs to generate a profit. That means you can generate 0.33 over a fixed cost, making it a profitable product. So this is the degree of operating leverage. The same thing, we can use contribution over our profit, right? Contribution over our profit. So contribution was still what? 80,000, and profit was what? Profit was 20,000, right? And this one is in times. So 80,000 over 20,000. That means our contribution is equivalent to 4 times of our profit. That means if we split the contribution into 4, right? We get what? We get 1 of it to be our profit and 3 of it to be fixed costs. So contribution covers 3 times of it as fixed cost. Then the 1 left is for profit. Right? So there are many ways you can look at this, but I think the first one is straightforward for you guys, right? You can also take variable cost over fixed cost. It's still degree of operating leverage. You can take fixed cost over variable cost, profit over fixed cost. They are all degree of operating leverage. It depends on how you interpret it, but go with this one, contribution over fixed cost. Okay, giving you what? 1.33, telling you the product is profitable so that you can get something to use in the interpretation. Is that understood? Is it understood?
Yes, sir.
Okay. I hope it's not something difficult. Just take your contribution over fixed cost. If it's more than 1, it's profitable. If it's less than 1, it is loss making. Okay, so the first method for dealing with multiple products is where you have the weighted contribution, right? I want you to use the weighted contribution approach. And how do you go about it? There are some steps. You know me, I'm a man of steps. I like steps a lot. So step 1 is to determine your sales mix, right? So determine the sales mix. Write it down, multiple products, CVP. So determine your sales mix. The sales mix is how you mix your sales. So let's say if we have product A, B, and C, right? Products. So I can write the products and the mix, right? Then the sales mix. So let's say that if I have product A, product B, and product C, right? It's better I take a question so that we use the question to go through the steps and then you understand it better. I hope that makes sense. What do you say?
That's okay.
So determine the sales mix. So we have a question here, right? And then we are going to use it to walk through that. So you follow as we go along, then you write as we go along, right? So we are saying that, okay, the first thing is to determine the sales mix, okay? What is the sales mix? How you mix and sell. So they are saying James produces and sells to product M and N. So we have, when we take the products, we take the mix, we take the sales mix that we want to get. We are saying that we have what? We have the M sells for 7, this sells for what? 15, we have all that. But the marketing department estimates that for every 5 units that we sell of M, we sell 1 unit of N. That is the mix, right? Do you all agree? What is the mix?
Yes, sir.
Take M and N. How much do we sell? If we sell 5 of M, we sell 1 of N, right? Make total of. Do you agree? That means our sales mix is 5/6 for M and 1/6 for what? For N. Do you get it? Do you get it? Is it understood?
Yes, sir.
Okay. Now that we have our sales mix, because we weighted average contribution, we are going to weight the contribution against the sales mix, right? So the next step is to find what? Our contribution per unit for each product, right? Contribution per unit. And how do we find contribution per unit? We have 2 products, product M and product N, right? We learned this. So contribution, we know is selling price minus our variable cost. You know, everything we do in management accounting is about contribution. So if I take selling price, when I go to the question, it tells me that product M sells for 7 cedis and product N sells for what? 15. And then variable cost for product, this guy was what? 2 cedis, 94 pesos, right? And this guy was what? 4 cedi, 40 pesos. So what's the expected contribution? What's the contribution per unit from this? So we have 7 minus 2.94. This guy goes for 4.06 per unit. Then we have 15 minus 4.4. That's 10 cedi 60 pesos, right? Okay, per unit. Now that you've done A and B, the next thing is to mix the two, right? Multiply the sales mix by the contribution to get the weighted average contribution. So my third step is to what? Determine the weighted average contribution. So anytime you have more than one product, you always use the weighted average contribution, not the normal contribution, right? So how do we do this? My weighted average contribution can simply be gotten by what? Just multiplying by my contribution by my sales mix, right? That gives you your weighted average contribution. So if you take your products and then you have what? Your contribution, you have your sales mix, then you get what? Your weighted average contribution. It's not really necessary to do all this table. You can just open bracket and multiply, right? 5/6 times the contribution and this. But just to be professional, this guy's contribution was 4 cedis and 6. Sales mix was 5/6, right? Giving us a weighted contribution of how much? We take N. This guy was 10 cedi 60 pesos by what? 1/6, giving us what? When you add up, you are now going to get weighted average what? Contribution. And this weighted average contribution is what you are going to use to work the whole question, right? Assuming they ask you for break even, instead of using the normal break even that you know, we are going to use weighted average contribution to do it. So 4.06 by 5 on 6, that's going to give us what? 3.38. That's all. And then we have 10.6 by 1/6, giving us what? 1.77. So you have 3.38 plus 1.77. And that gives us 5.15. I hope that is clear. So this is now the weighted average contribution. So assuming they ask me units to, if they ask me what? Number of units to break even, right? What would that become? Become a fixed cost over what? Becomes fixed cost over what? It becomes fixed cost over what? It becomes fixed cost over what? Oh, it's the same formula. Number of units to break even, how do we get it? Number of units to break even, how do we get it?
Fixed cost over contribution per unit.
But now since it's multiple products, it becomes fixed cost over weighted average what? Contribution per unit, right? Yes. That's how you do it. If you want number of units to make what? To make a profit, it's going to be what? Your fixed cost plus what? The target what? Profit all over what? Weighted average what? Contribution, right? So all the formulas you learned is still the same, but here you end up using what? The weighted average contribution rather. Makes sense? Makes sense? That's the only difference. Does that make sense to everyone?
Yes, sir.
Yeah.
Okay. So the next question they asked was that calculate the break-even point for Jinx. So what's the break-even point? The break-even point, we already know the break-even point. Break-even point is in unit, right? So that gives us what? Our fixed costs over what? Our contribution per what? Our contribution per unit, right? And per this question, it told us that fixed cost was what? 123,600. So this one divided by our contribution per weighted average contribution per unit of what? Was it 5.15, right? That's 5.15 per unit. Okay, so how many units must be produced to break even? That means we must take our 123,600 divided by 5.15. That gives us what? 24,000 units. Okay, that means we must produce and sell 24,000 units to break even, right? But then, how do we get our break even for each product? Remember this one, there's multiple products, right? So break even for each product becomes what? Remember that each product was spread in the sales mix, right? So the sales mix can be used to split this. So if I take product M and I take product N, I know that what? This is the product. This was the various sales mix for each product, right? And this was what? The break-even. So to get what? The break-even per product, you can easily do it. You know that this guy, for every 5 we sell one of that, right? So 5 on 6 and this one 1 on 6. We can use this to split the 24,000, right? To see how much of the 24,000 should be for product M and how much of the 24,000 should be for product N. Straightforward, right? So we have 5 on 6 by our 24,000. And that gives us what? 20,000 units going for product M. And that means the rest to be what? 4,000 units going for product N, right? Putting it together, that gives us our 24,000 units. Exactly. Does that make sense? So you see, you just use the sale. Everything is about the sales mix. We just use the sales mix to split it. What if I want break even in sales revenue? What do we do? Because we already know the break even unit, right? We can just multiply our break even unit by the selling price for each product. Do you get the idea? So that it's straightforward instead of using CS ratio, which can become long. So I can just take the product, not so, and then we have what the break-even units, and just multiply by the selling price. Then I get the total sales or the total revenue. I get a break-even. Is it understood? So if I take product M, we know that we are selling 20,000 units, and each of them, the selling price was what? 7 cedis per unit. Do you remember? And then for product N, we are selling 4,000 units at break-even, and the selling price was 15 cedis per unit. So what does that give us? So this one gives us 140,000, right? And this one gives us what? 60,000. True or false? We put it together. Do we get 200,000? Yes. So this is the total revenue. So the company must sell a total of 200,000 in sales, or make a total of 200,000 cedis in sales to break even. Is this thing difficult? You can flow with the steps, right? Determine sales mix, contribution, weighted contribution. You can use it to find your break even. Then split it for each product, use it to determine your sales revenue. And this thing you see like that is 20 marks. You see it, this is a simple method, right? Please give me your feedback and then let's take another one. Is everybody okay?
Yes, sir, I'm okay.
Yes, sir.
Okay. Any question, any confusion? Any question, any confusion?
No, sir.
That means everybody's fine.
Yeah, I'm okay.
So now let's go to an alternative method. It doesn't mean that you can choose any of them, but I prefer you use what I taught you first, right? But sometimes you may go to the question and then that option is not available, right? You can only, that's why everything I teach you, I make sure I teach you all the methods, because you can go and then you go and then you realize that you only have that option to use, right? Do you understand? So how do we deal with that method? So that method is the CS ratio approach. So we've done method 1. I hope you wrote the solution. Or you took shots so I can proceed. Let me know so that we move.
So we wrote it down.
Okay. So this is the method 2, right? The method 2 is where we use the weighted average CS ratio, right? Where we use the weighted average CS ratio. So here, the first step is still one, to determine what? The sales mix, right? So still determine sales mix. And we know the sales mix M and N, right? When we sell 5 units of M, we sell 1 unit of N, giving us 6. Sales mix to become what? 5 out of 6 and 1 out of 6, right? So after this, the next step is to determine what? Is to determine the what? The CS what? Ratio, okay? So this is the CS ratio approach. So how do we get the CS ratio? We know for product M, we've already got the contribution, right? So we can just divide the contribution over the sales, but let's just get the contribution. So CS ratio. So first, what's our contribution? So I can go this way, right? So product, selling price, variable cost, contribution to sales ratio, right? So when I take M, the selling price was what? 7. Variable cost was 2.94. Contribution was what?
4.06.
4.06. Selling price was what? 7, right? So this becomes 4.06 over what? Over 7, giving us CS ratio of how much? 4.06 divided by 7. So I have 20.
3.5.
0.58. Is that what?
0.58.
Exactly, right? So you just keep it like that, 0.58 as the CS ratio. Okay, for N, the selling price was 15. This one was 4.4, right? Giving us contribution of how much? 15 minus 4.4.
10.6.
10.6, right? So this one ends up giving us 10.6 over 15. Also giving us what? 10.6 divided by 15. But you see this one will give us 0.70666667, right?
Yeah.
Which is 53 point what? 10.6 divided by 53 point what? 75. 53 over 75. I told you when it is a decimal, you just keep it as is, right? Keep it as a fraction. So I'll just leave it as a fraction as it is, okay? So the next thing we have to do is what? What's the next step? Determine what? The weighted average was CS ratio, right? No be so. So getting weighted average CS ratio, if I take product M, I'm just going to multiply my 0.58 contribution to sales ratio by the sales mix, which is 5 over 6, right? And then when I take product N, I'm going to multiply what? My 53 over 75 times what? My 1 over 6. Do you know why? I just want to maintain the fraction because it is giving me an irregular fraction, right? An improper fraction. 0.58 by the 5 on 6 is going to give me what? 0.4833. And then this one, we have 53 over 75 times 1 over 6. So that one too is going to be 0.1177. 1, 2, 3, 4, 5, 1, 2, 8, right? So once I have this, I have like the weighted average CS ratio, right? Weighted average CS ratio. So I will just add it up. So I'll have 0.6, 0.601 or 0.6. If I like. Okay. I have 0.6 as my weighted average CS ratio, right? After rounding it off. So now that I have this, you see, we didn't get perfect fraction. So it's going to affect the figure. It'll be slightly different. That's why I don't like when the figures, but still, it's just to teach you for you to understand, right? So now that I have my weighted CS ratio, the next thing to do is to find what? My break-even unit in sales. Remember, CS ratio is only for break-even units in what? Break-even in sales. Do you remember? break even in revenue. How do we get it? We know that that one is giving us our fixed cost over what? Our fixed cost over CS ratio. But here, we use weighted average CS what? Ratio. True or false? So here, fixed cost was 123,600 divided by the CS ratio, which was 0.6. Remember, so in that case, this gives us what? 123,600 divided by 0.6. That means I end up with 206,000. You see, because of the rounding offs. So that means that the company must make revenue of 206,000 to break even. But you see, we got 200,000 in the one we did first, right? It was because of the rounding off. So you see, it was closer. Can you all see? Can you all see?
Yes, sir.
So with that being said, now we are going to determine break even in sales for each product, right? For each product. Now all we have to do is just split it in the sales mix. So if I take product M, we know that it's 5.6 times the 206,000. Not so. That tells us how much of this 206 goes for product M. Not so. So at 206,000 by 5 out of 6. And that gives us 171,667 units. And then for product N, gives us 1 out of 6 times the same 206,000 units. Then we split it as follows. See, this one will end up with 34,333 units, right? When you add all up, you still get there. It's not units, it's revenue, right? We have break even in sales. Sorry, it's not units, it's revenue. Okay, so we still have the 206,000. Okay. Now we need a break even in units for each product, right? In units for each product. If you are giving revenue and you need units, how do you do it? You take the total sales divided by the selling price per unit. True or false? Is that not so? Is that not so? Is that not so? If you want units, don't you divide sales by selling price per unit? Because we know that the sales is equal to our selling price per unit times the number of units. Meboa. Is that not how is that not how it is? So if you want to get a number of units, what do I do? What do I do? Don't I take the sales and divide by the selling price per unit? True or false? True or false?
True.
So if I take
True.
product M, I know product M, we shared, how much did we share for him? 171,667, right? As sales, 171,667 as sales. We just divide by what? Our selling price per unit, which was 7 cedis per unit. And then it means that the break-even units for this guy is going to be 171,667 divided by the 7. That means we have to sell 24,524 units to break even for this guy. Then when we come to product N, it was 34,333, right? So we take sales of 34,333 and divide by what? It was 15 cedis per unit for the selling price. That gives us what? 34,333 divided by 15 cedis. And that means we must sell 2,289 units to break even, right? So these are the two methods, right? I just decided to teach you both so that actually the figures would have been just the same. It's because of the rounding offs. Assuming you didn't round off anything, we'll get 20,000 and 4,000 exactly. Okay. Understood? Or you want us to take another example? Which method is okay for you, first or second? The first one. First one is straightforward. Which one is okay for you guys? First or second? Give me confirmation and let's go. First or second?
We are yet to wait.
Okay. So, question number 2. A firm manufactures multiple products, namely FG and H. The products are sold in the ratio FG and H 2:1:3. And the firm's fixed costs are 80,000 per mount. And details of the products are follows, right? The firm wishes to earn a profit of 52,000 next month. So they says calculate the sales value of each product in order to achieve this target profit, right? That's the first thing we need. So what's the steps we need to follow? What's the first step? We need to determine the sales mix, true or false? So what becomes the sales mix? So we have the products, we have product F, product G, and product H. What's the mix? Anytime we sell 2 of F, we sell 1 of G and 3 of H, right? Making 6. So the sales mix is 2 out of 6, 1 out of 6, and 3 out of 6, right? We have this. I hope this question is now making it clearer. The next thing is to determine our contribution per what? Contribution per unit. Not so. That's the next step. So let's get our contribution per unit. So we have product F, product G, and product H. Selling price. This guy was 22, 15, 19. Less variable cost. This guy was 16. This guy was 12. This guy was 13. Okay, let's put them together, giving us our contribution per unit. Please give me the figures and let's move quick. We don't have time. 22 minus 16. This 6. We have 15 minus 12, giving us 3. We have 19 minus 13, giving us what? 6, right? Okay, so we have their contribution. What's the next step after contribution? What's the next step after contribution? What's the next step after contribution? What is the next step after contribution? Oh, my people. What is the next step after contribution?
So you determine the weighted average contribution.
Weighted average contribution, thank you. What are weighted average contribution? So how do we get this? We just take our products, our contribution, and our sales mix, right? To get our weighted average contribution. Okay. So our product, we had product F, G, and H. This guy had contribution of 6, 3, and 6. Sales mix, that was 2 out of 6, 1 out of 6, and then 3 out of 6. That's just multiply each. Then you get your weighted average contribution. So this one gives us 2. This one gives us 0.5. This one gives us 3. Is it correct? Is it 5.5? Is it correct? So the next question is what? Sales in order to achieve target profit. Sales value in order to achieve target profit of 52,000, right? So first of all, I need units to achieve target profit of what? 52,000, right? And what do we get for the formula? That's our fixed cost plus the target profit, not so. All over our contribution per what? Unit, right? Which is our weighted average contribution. So with that being said, straightforward, we know our fixed cost was 80,000. And then this one is what? 5.5, not so, plus our 52,000 profit that we want to make. Not so. So how much are we expected to make? That's the 80,000 plus the 52 thousand estimated target profit, 132 divided by 5.5. That means we must produce 24,000 units, okay, 24,000 units to break even, right? So these units that we know that are going to make us break even, we can now split it, right? So break even per product. Let's go and get it per product. We know that for product F, it was 2 out of 6. We split it into the 24,000 to see how many units we need. For product G, we need 1 out of 6 by the same 24,000 units. For product H, we need 3 out of 6 by the same 24,000 units to know how much of these products we are splitting, right? So 2 out of 6 by the 24,000. That means this guy, we need to produce 8,000 units to break even. This guy, 24,000 by 6, 4,000 units must be produced. And the last one, need to produce 12,000 units of that product to break even, right? Still giving us the same 24,000 units. I hope that is clear. So now that we have this, we need the selling price for each product, right? Sales per, we need sales per product, right? To break even. And now, what is the sales revenue at break even, right? We know that F, the break even unit, this one, we are just multiplying the break even unit by the selling price per unit, right? So this one, we know that we are selling 8,000 units, but at 22 cedis. And then G, we are selling 4,000 units, but at what? 15 cedis. Then for H, we are selling what? 12,000 units, but by what? 19 cedis. So. Okay. So what then do we have? So 8 by 22, 176,000, 4,000 by 15. That is 60,000. You have 12,000 by 19. That's 228,000. 176,000 plus 60,000 plus 228,000. And that gives us 464,000. So this is the selling price to break even. So required sales value to break even is equal to 464,000 Ghana cedis. Right? Is this thing difficult? Should we try the alternative method too?
Hello, sir.
Yes, William.
We play with you. Try to upload the video because some of us are not getting concentration because of where we are. So that we, at our convenient time, we can watch and get what we are doing.
Okay, sure. I'll do so. Okay. So, but I
Thank
hope so far, so good. Can we try the method 2? You see, this one, it would have been more appropriate to use the method 2 to get it straightforward. But because of ticks, so method 2, what we needed was that one with the CS ratio approach, because here the acts of sales value, and we know that sales value, it is CS ratio, it is always our fixed cost plus the target profit all over what? Our CS ratio, right? So that would have been more appropriate. Okay, so that's why I said, look at the one that best takes it. What we did was not bad, but somebody can also use this CS ratio approach, right? That the first step, we already know our sales mix already. So the first step, I always determine my sales mix. This is my approach. Some other people do it in a different way. I always like to simplify things for students. So I have F, G, and what? H. I know this guy was what? 2 out of 6, 1 out of 6, and then what? 3 out of 6. No, so I have this down. Now I need my CS ratio, right? Now I already have my contribution. So I have product F, G, and H. No, so I have my selling price, this guy being 22, 15, 19, then variable cost. We have what? 16, 12, and 13. So 6, 3, 6. We already have this, right? So I need my CS ratio, which becomes 6 out of 22, 3 out of 15, and 6 out of 19. So what do we get for the CS ratio? 6 out of 22. This one to gives us 0.2727, recurrent fraction. Then 3 out of 15, 0.2, and 6 out of 19, 0.3158. I've rounded off, so we'll get something closer. That's why I said this one, mostly, I don't like it because of the rounding off. So you're not going to get a perfect decimal. So the next thing is to get what? Our weighted average CS ratio, right? And our weighted average CS ratio for F, you know that we have CS of 2727 by our 2 out of 6. For J, we have what? 0.2 by our 1 out of 6. And then for H, I have what? 0.3158 by our 3 out of 6. No, so we have already weighted the CS ratio. Okay, so we have 0.2727 times 2 out of 6. We have 0.909, 0.0909. We have 0.2 times 1 divided by 6. We have 0.0333. We have 0.3158 by 3 out of 6. We have 0.1579. If you add everything up, you have 0.0909 plus 0.0333 plus 0.1579. You end up with 0.2821, right? So now I have my weighted average CS ratio. So all you have to do is that what? If I want my break-even point in revenue, right? Can just take my fixed cost. No, it is number of units, right? Number of units to make or revenue to make profits of 52,000, right? So I take my fixed cost plus what? The target profits, fixed cost plus the target profits all over my weighted average CS ratio because I need revenue. So in that case, fixed cost was 80,000. I want to make profit of 52,000 divided by CS ratio of 0.2821. Okay, that gives me the total amount in revenue, which is 80,000 plus 52,000 divided by 0.2821. So you see, you end up with 467,919 as the revenue. But you see this one, we had 464,000. But look at this one, we had 467,000. You see, they are closer. It's because of the rounding ups that we did with these decimals. Is that okay? Is that okay?
Yes, sir.
Yes, sir.
I like the yes, sir. Okay, so now it is your turn to get the difficult or the ones that involve a lot of, you know, this has happened, this will happen, and all that. So we are looking at all the different types of CVP questions that have appeared, right? We're looking at all of them. So we are first going to start with, I don't have last night's paper, but let's start with, I think, November 2015, question 5. We'll go in that fashion, or let's start from the highest and come to the lowest. Okay. So we'll start with normal CVP, then we'll come to target profit decision. So November 2019, question 5A. 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 Where are my past questions? November 2019, question 5A. November 2019, why? November 19, question 5A. Let's start with that one. We are November 19. Let's go to question 5. Okay. I'm there. November 2019, question 5A. Okay. It says what? Graphics Communication Group Limited is a magazine publishing company, and it comprises a number of different divisions, each publishing magazine in a different sector. GCGL is now considering publishing financial magazine. The financial magazine market is very competitive with a number of well-established titles already having been published by GCGL's competitors. Financial magazine is a monthly magazine, and GCGL has therefore commissioned an advertising campaign to launch its financial magazine. The price of the financial magazine has been set at full cost plus a markup of 20%. That's the price, right? And the forecast variable cost per copy of the financial magazine is given. So they've given us paper 0.83. And then they have given us ink, machine cost, and other variable costs. So each financial magazine needs 0.2 liters of ink. However, 10% of the ink input is wasted. Ink cost, oh, this is not, I don't think this one is, what do we call it? CVP. Oh, okay. It can be wet. You can also use it to CVP's decision making. Anyway, let's see. After the first month of sales, GCGL expects 90% of the first month's customers to purchase the financial magazine in month 2. After the second month of purchase, it expects to retain 85% of month 2 customers in subsequent months. As the magazine circulation area increases, sales to additional new customers in month 2 will be 20% of month 1 sales figure. 90% of this will be retained in month 3. Sales to additional new customers in month 3 will be 30% of month 1 sales figures. Fixed overhead are apportioned by GCGL to the financial magazines based on first month sales volume. Total budgeted annual fixed overhead is 18 million and total month sales volume. And total budgeted annual magazine sales, including financial magazine, is 12 million copies. The sales price of the magazine will remain unchanged throughout the first 3 months. Okay. Discuss 2 advantages and 2 disadvantages of the managing director's pricing strategy in the circumstances above. Cost plus a markup. You have to identify the advantages and disadvantages. Produce a statement that shows the total profit for the first 3 months of financial magazine. Calculate the number of copies that need to be sold to achieve a profit of 100,000. Okay. You see how this thing is. So all the knowledge that you have acquired, you are now going to put them to play. And how do you do this? So what's the first thing you think we need? We always need contribution per what? Contribution per unit. And how do we get contribution per unit? Selling price minus what? Variable cost. Here lies the case. The variable cost, we have paper, ink, machine cost, and other variable costs, right? It seems this machine cost here is a variable cost, direct cost. But here lies the case. The ink, we are not getting the ink cost, right? So let's try and see if we can get the ink cost. They are telling us that each financial magazine needs 0.2 liters of ink. Ink required, we need what? 0.2 liters of ink for production. However, 10% of the ink input is wasted. They are telling us that 10%, there's always wastage of 10%. Okay, my question is, if you go and buy and then there's a waste, is the supplier concerned about your waste?
No.
No, then
He's not concerned about the waste, right? So you are saying that how much is the actual input that we put in before the wastage? It will become the 0.2 liters over 0.1, meaning that you are saying that if 0.2, or this one, whatever is this will be 0.9, sorry. If 0.2 is equal to 90%, do you understand? Do you understand? Because we've lost 10%. Do you get it? If 0.2 is equivalent to 90%, then how much is 100% that we put in? Do you get it? And if more or less divides, right? That means we put 0.22 liters in, then we lose 0.02 out, right? And they are telling us that the ink costs 5.4 per liter. And it is the cost that we need. Also, because you cannot consider the effect of the wastage. You just need the cost. Do you get what I'm trying to say? Sorry. Something just ouch. Ouch. What is this? Why is my pen not working? Okay. So where were we? We are saying that in month 1, that is just for 1 month, they expect to sell 50,000 copies to new customers at this price. And each financial magazine needs 0.2 liters of ink. However, 10% of the ink input to the printing process is wasted. Okay, and the ink costs what? 5.4 per liter. Okay, if 5.4 per liter, then 5.4 per 1 liter, right? But we need 0.22 liters of ink. So that will cost how much? Do you guys get me? Do you guys get me? Don't know if I want to that long. If 1 liter costs 5 CD 40 pesos, then since we have considered the effect of the wastage, I get it. Because 0.2 is the liters that we require because we are going to lose 10%, meaning that if we lose 10%, this is equivalent to 90%, right? but we've got 100% capacity now, the 100% we put in. So we are saying 1 liter gave us 5 cedi 40 pesos. Then the 0.22 liters that we need will cost how much? It will be less, no so. So if less, more divides, no so.
More divide.
We end up with what? 1.18. So 1.19. Give us 1.19. That means that the ink, without the effect of the loss, will give us 1.19. Do you get it? Another student will say that, okay, we put in 0.2 liters. So 0.2 liters times the 5.4 will give us what? Do you get it? So 0.2 times 5.4 will give us 1.08. And this 1.08 is equivalent to 90%. So if this is 90%, 100% will be what? So 100% would mean that we will take what? The 1.08 and divide by what? 0.9. And we'll come and get 100% straight, which is 1.2. Okay, it's just equivalent to this. It's because of the calculation and the rounding offs. Because it was not 0.22 exactly, right? So you see, you get 1.2 or 1.19. It is still closer. It will still give you the same figure. You get it? So now you've got the cost of the ink. You see management accounting. To get contribution, Keke, we've got the cost of the ink now. So we get our total variable cost per unit now. So our variable cost per unit, we have what? Paper. Paper is a direct material, 0.83 per unit. We have ink. Let's use 1.2 or 1.19. Also, we have machine costs per unit, giving us 0.22. We have other variable costs being what? 0.15. Okay. We put it together. What's our variable cost per unit? .83 plus 1.2 plus 0.22 plus 0.15. 2 cedi 40 pesos per unit. Are we there? Are we there?
Yes, sir, we are here.
So now that we have our total variable cost per unit, the question is, how then do we get the selling price? You know that they said they have a markup of 20%. So they said full cost plus a markup of 20%. That means we need fixed costs. We need fixed costs. Fixed overhead are apportioned based on first month sales volume. And the budgeted annual fixed overhead is 80 million. Budgeted annual fixed overhead. So let's see. We need full cost. We need to get our selling price, right? So the total year, the annual budgeted fixed overhead is 80 million. So if we like, we can use everything on this 18 million. I get him to get it. But it is full cost plus markup of 20%. And then we are using what? The fixed costs are apportioned to the financial magazines based on the first month sales volume. How much did they sell in the first month? 90% of first month's purchase. Expect 90% of first month customers to purchase the financial magazine in month 2. First month purchase. 50,000. Oh, okay. In month 1. Okay. So the first month they are expecting to sell 50,000. And are they going to sell the financial magazine based on the question? Are they going to sell it for the whole year? Because we have a budgeted annual fixed overhead to 18 million. So that means our total variable cost would have been what? Total annual magazine sales. But this is only for the financial magazine. The 12 million are for all the magazines in the organization. Look at it carefully. The 12 million here is for all the magazines in the organization. But we only need the financial magazine. How many months of this is the financial magazines? That means we need to get a number of units before we can say we can find the selling price. I like the question. Do you agree? The management accounting is thinking. Not time. For decision-making questions take a lot of time. But at least you can get your basic marks. Like the workings we've done here, you would have gotten some marks, then you are gone. So month one, how much? It's supposed to be interactive for us to understand. Month one, how many are we expecting to sell? Units to sell. Month one. Month one. They said we'll sell how much? 50,000 copies. Oh, please, are you all following? We said we are expecting to sell 50,000 copies. Not so.
Yes, sir.
Month two. Just lay out all your variables. Month two. They said what? 50,000. After the first month of sales, it's expected that 90% of the first month's sales to purchase in month two, right? That means 90% of the 50,000 units will be sold in the next month, right? So the next customers are going to purchase what? 90% of the 50,000. That means we will sell what? 45,000 what? Copies to them. That's so. And after the second month, they expect to retain 85% of month two customers in subsequent months. You see the way it is. So that one is going to be what? They retain 85% of what? Month two customers, which is the 45,000 copies, right? Will be retained. So 0.85 by the 45,000. So we expect to retain 38,250 copies throughout the whole year, right? After month three. And they said, as the magazine area increases, sales to additional new customers in month two will be what? 20% of month one sales figure. That means sales is now going to increase by 20% in that month. Here we are looking at the number of units. And 90% of this will be retained in month three. Sales to additional new customers in month three will be 30% of the month one sales figures. Fixed overhead are apportioned to the financial magazine based on first month sales volume. Okay, based on first month sales volume. So we have to use the first month sales volume to apportion the fixed overhead. So how then do we apportion the fixed overhead then? Yes, I want your opinion here to know whether you get what I'm trying to say. How do we apportion the fixed overhead? Yes, I'm waiting on. Yes? Nobody's saying anything. You just guess. That's why you are here. That's why we are learning.
So I see 18,000 to be the budgeted annual fixed overhead.
Okay.
Yes, and then there's another, they are saying the total sale is 12. Okay, so the overhead is the 18,000.
Okay. So that means we need our OAR, right? I believe you should have said that. Which is our total budgeted what? Our total budgeted fixed overhead over our total budgeted level of activity, right? In this case, the level of activity was the units produced or the copies, right?
Yes,
So
sir.
to get our fixed cost, we know that our fixed cost was 18 million in this case, not so, all over our 12 million copies, right? So because it says full cost, we all know full cost. We learned it last week that full cost means what? Variable cost plus our fixed cost, right? Do you remember? And full
Yes, sir.
we need to get full cost. That means you are getting fixed cost per unit. That means you are using absorption costing here. So 18 million divided by 12, 1, 2, 3, 1, 2, 3. That means this one was 12 million. So 18 million or 180 million, 18 million, 18 million over 12 million. That means fixed overhead cost per unit is going to give us what? 1 CD 50 pesos per unit, right? We've gotten it. That means now we can get full cost per unit, right? So our full cost, we know, is variable cost per unit plus our fixed cost per unit. Already we had variable cost per unit to be what? How much was our variable cost per unit? 2 CD 40 pesos, not so. So that was 2 CDs 40 pesos per unit plus our fixed cost per unit, which is 1.5 2 CD 40 pesos per unit plus our fixed cost per unit, which is 1.5 per unit. So that gives us what? 2.4 plus 1.5. We have 3.9 per unit, right? So this is our full cost. And it says what? The company does what? Markup. Where was it? We read it. Markup of 20%. Full cost plus markup. Okay, full cost plus markup. So we said when we hear, anytime we hear markup, it means that cost is equivalent to what? 100%, not so. But here lies the case, we want selling price. Not so, we want selling price. So in that case, selling price, we know cost plus profit equals selling price, right? If cost is 100, markup is 20, meaning selling price must be equivalent to 120%. So we are saying that therefore our selling price becomes 120 out of the cost, which is 100 times the 3.9. This should give us the selling price of the magazine. Just 120 out of 100 times 3.9. That means the selling price of each magazine is going to be 4 CD 68 pesos. So that is the selling price of the magazine at full cost plus a markup of 20%. Dun, dun, dun. Are we okay? So they said, now we've got the selling price of the magazine. We've got the copies that will be sold for each month. But they said that these are existing customers who will be selling to. But they are saying that what, as the magazine circulation increases, we will get additional new customers in month 2, okay, who are also going to what? Have additional what? They are going to get what? 20% of month 1 sales figures. So if I like, I can say what? Month 1, month 2, month 3. What's the CVP and that form? Thinking, I see a form to me at the papa. You have to think plenty, and by the time you see this thing has wasted your time, but it's good we are learning it so that it becomes an eye opener. So let's see. Already we've compiled our sales already, 50, 45, and 38 to 50. So for the existing customers, this guy we have 50,000. This guy we have 48,000. Was it 45 or 48? 45 of 45,000 copies, yes. So these guys we have 45,000 copies, and these guys we have 38 to 50. But they are saying that we will have some additional customers, right? Additional sales or additional customers. And as the circulation, additional new customers in month 2 will be 20% of month 1 sales. So 20% of month 1 sales will be what? 0.2 times 45,000. 0.2 times 50,000. We'll get additional sales, 10,000. So we'll get additional 10,000 sales in this month, right? And then they say what? 90% of what we had will be retained in month 3. 90% of what we had will be retained in month 3. So 0.9 by 10,000 will be 9,000, additional 9,000. And they are saying that sales to additional new customers in month 3 will be 30% of month 1 sales figures. So 0.3, we have additional sales again in month 3, which is 30% of the 50,000 in month 1. It's about 15,000 new sales again. So if we should add everything up, this month was still 50,000. This month was now 55,000. And then this one, we have 38,250 plus 9,000 plus 15,000. That's about 62,250 copies overall. So these are the total copies expected to be sold. Calculation we cry, majority of students will get it wrong. Let's be honest, true or false?
Say, true now, ma, we anything.
Mark, then now you go through all
What?
this.
When you saw me a baby, and
Oh no, it's not always. This one is more of a decision-making type of question, right? So you can, in an exam, you can have this type and still have the normal type in the same exam. So sometimes you go question 1 to 5, you see CVP appearing about 3 or 4 times. One being pure decision-making like this one, and another one being the normal one, and another one to being part of variance. So don't worry. That's why I'm giving you all the different ways it can come. It doesn't mean you have to be able to do all. At least be able to do some few calculations and get your 5, 6 marks. We now call it. Do you understand? Aha. So the next question was that produce a statement that shows total profit for the first 3 months of financial magazine. First 3 months, right? So just that I'm going to divide the fixed cost. I know my fixed cost is what? It's for, what is it? Fixed cost 1.5 per unit, right? And fixed cost is fixed. So I can just divide the 80 million times 3/12 to get how much that would be. So I know my sales already. Being this is my sales unit, right? So month 1, month 2, month 3. So if I want my sales, straightforward. Already I have the units there for month 1, month 2, month 3. So the selling price was 4.68. So the first year will be 50,000 by the 4.68. And that gives me 234,000. So we have 55,000 by the 4.68. This one gives me 257,400. We have 62,250 by 4.68. We have 291,330. No, so then we have less our variable cost. Variable cost, we know it was 2.4. So was it not 2.4? So 2.4 by the 50,000. This guy gives us 120,000, which is the profit statement. It's 55,000 by the 2.4. That's 132,000. We have 62,250 by 2.4. We have 149,400. No, so with that being said, we have our total contribution. However, we could have got our contribution per unit, keke, straightforward. You know that. And then we'll just multiply by this, get a total contribution, less our fixed cost from it. Then we are good to go. And that's our contribution that we need. So we have 234,000 minus 120,000. That's 114,000. Of 257,400 minus 132,000. You have 125,400. 291,330 minus 149,400. That's 141,930. Then we less fixed costs. So fixed cost, I can just take my 18 million and multiply by 3 on 12. I said 3 on 12 divided by 12, right? Divided by 12 because I want the fixed cost per month. 18 million divided by 12. So each month, will give me how much? Figures I have here is small. These are part of the magazine sales. These are part of the magazine sales. The fixed cost was 1.5 per unit, right? If we use the 18 million, it will result in losses, big losses. So if we can multiply 1.5 by the 50,000. That gives us 75,000 for the fixed costs based on month 1. Then month 2, I think the same thing will be maintained across. Did they say that? The sale price will remain unchanged through the first 3 months. Okay. Total annual and total budgeted sales, including financial magazine of 12 million. It's 12 million copies. Okay, and we have 1.5. So 1.5 throughout by the copies. So fixed cost will remain unchanged, but here 82,500, then 62,250. We end up with 93,375. Then you can now get the profit for each month. Assembly. Number of copies that need to be sold to achieve a profit of 100,000. We put the anchor, you don't have to work this part. You could have.
So, okra break.
You could have. I'm just giving you an example technique here. See, you could have not wasted your time here for this, right? Because this one says number of copies to be sold to achieve a profit of 100,000. Which this one we know that straightforward is the fixed cost plus the target profit, right? All over what? Contribution per unit. Remember, is that not so? Is that not so? So this one you could have gotten your 6 marks straightforward, and here you would have laid down your figures instead of doing the profit. Calculate means some 4 marks be. It's all part of exam technique. So here we know that the fixed cost itself was what? The fixed cost was 18 million, but we want 100,000 divided by the contribution per unit. On contribution, we know that our contribution is our selling price of the 4.68 minus our $2.4, right? That's our contribution. So 4.68 minus 2.4, 2.28. 2.28. So if we like, you can just add all the units that they are selling, which is 55,000 for the magazines plus 55,000 plus 62,250, which is 172,250, all at 1.5. That will give us 258,375 for only the magazines. So if you like, only the magazine fixed cost is going to be 258,375 plus 100,000. 258,375 plus 100,000. That's 358,375 over. So that gives us 358,375 over 4.68 minus 2.4. That's our contribution. 2.28 per unit. So the number of copies 358, 375 divided by 2.28. That means they must produce 157 units, 182 copies of magazine in the 3 months to break even. Assembly. Okay, don't worry, we'll get there. November 2021, question 5. November 2021, question 5. November 2021, question 5. I think they like bringing CVP in question 5. Let's see this one too. It says Claudia Footwear has developed a new range of high-quality, affordable sandals for beachwear. The sandals are based on an innovative design that protects feet from the effects of sun, salt, and sand. The company has already received some sales orders for 9,000 sandals, which form 75% of operating capacity. And what did we learn? We said that anytime we see something at a different capacity, what are we supposed to always find?
100% capacity.
100% capacity. So that's the first thing we always do, right? So we find 100% capacity. So 100% capacity will be what? If 9,000, 75% capacity was for what? How many units?
9,000.
So 9,000 is equivalent to what? 75%, oh sorry, 9,000. So 100% will be what? I told you 100%, we can always what? Take this divided by what? 0.75, right? So what is the original 100% capacity? What will we get for that? Yeah.
Okay. So 12,000.
You get it. So we know that the overall capacity is 12,000 sandals. But whatever we have here, these projections are based on 75% capacity, right? So with what we have here, we can easily find what we need. I told you anytime you see CVP, what are we concerned about? What are we concerned about?
Contribution per unit.
Contribution per unit. That's all we are concerned about. So the first thing is, how do we get contribution per unit? What we have here is at 75% capacity, right? So I must divide to get everything that I need per unit, right? Only this thing. So what's our selling price per unit? What's our selling price per unit? I'll take my 288,000, not so, and divide by what? The 9,000 sandals. True or false? I hope everything is making sense.
Yes, sir.
2,000 divided by the 9,000. That gives us 32 cedis per unit. Okay. Then variable cost. We have our direct materials. Direct materials 54,000 divided by 9,000 sandals. So direct material give us how much? So 54,000 divided by 9,000. 6 cedis per unit, not so. We have direct labor. 72,000 divided by what? 9,000 sandals, not so. So 72,000 divided by 9,000. That's 8 CDs per unit, right? And then we come to variable production overhead. When you look here, it tells us that what production overhead is made up of fixed and variable proportions 7 to 3 respectively, right? So that means that the production overhead, the 3 out of 10 or 30% of it is worth what? Variable, right? Do you all agree? Do you all agree?
Yes,
Because
sir.
it's split 7 to 3, and 7 plus 3 is 10. So that means fixed is 7 out of 10, and variable is 3 out of 10 also. So that means this one, I can easily say that, okay, variable overhead is what? 3 out of 10 by the 60,000 also, all divided by 9,000 what? Sandals also. Do you all agree? So that I can get my variable overhead per unit to 60,000 by 0.3, which is 18,000 divided by 9,000 sandals. That means this one is also 2 CDs per unit. Not so? Are we okay? So if you go down, they said 36,000 of the total administration, selling and distribution cost is fixed, and the remainder varies with sales volume. That means when you look at all of them, they are telling us that what? The total selling and admin and distribution of 63,000, 36,000 of it is fixed. That means how much is variable? That means how much is variable? So variable selling and admin. How much is variable? The total was 63,000, but the question is saying that 36 of it is fixed. Meaning how much is variable? Yes. Do you get where I'm coming from, or it's not clear?
Sir, it's clear.
27,000 divided by 9,000 sandals. That one gives us 3 CDs per unit, right? So now we know our total variable cost to be how much? Let's add all up. So we have direct material being 6 plus 8 plus 2 plus 3, giving us 19 CDs per unit. Selling price was 32 CDs per unit. So in that case, our contribution per unit, which you know is selling price minus variable cost, will give us our 32 CDs per unit minus our 19 CDs per unit, which gives us what? Contribution is 13 CDs per unit. You see, every question has its own style. Have you noticed? Have you noticed? Have you noticed? So now that we have contribution, now we need fixed costs. And fixed costs, the first part of fixed costs was what? Production fixed cost, right? And also production fixed cost. We know it will be 7 out of 10 times the first what? 60,000, which we had, right? You know that 70% of it was what? Of the production overhead was fixed cost. Do you all agree? So 7 out of 10 times the 60,000, that is 42,000 as our fixed cost. 42,000. And then fixed, selling, and admin. That one, the question already said it was 36,000 also. It's fixed. So if we add, these are the total fixed cost. So 42,000 plus 36,000. And that is 78,000, being our total fixed cost. Total fixed cost. Okay, so we've got our total fixed cost. We have our contribution per unit. So the first question is calculate break-even point in unit and sales value. So can we get our CS ratio? You know always we need CS ratio. CS ratio is our contribution per unit all over our selling price per what? Unit. Contribution per unit, we had 13. Selling price per unit, we had 32. Can we get it? So that's 13 out of 32. This one gives us 0.40625. Okay, this one it ended there, so I'll maintain it like that. So that's my CS ratio. So the very first question that was asked was that we should find our break-even units, also break-even point in what? In units and value. So in units, how do we get it? Is it not fixed cost over what? Give me the formula. Fixed cost over what? Fixed cost over what? Fixed cost over what? So contribution per unit, right? And then our fixed
Yes, sir.
cost is 78,000, not so. Divided by what? 13 cedis per unit, not so. So in that case, 78 over 13 cedis per unit is going to give us 78,000 divided by 13. That means the company must produce 6,000 units to break even. Okay. Then we need break-even point in value. That means in sales, right? We know this. Break-even unit in sales. You can just take the existing was 6,000 and just multiply by the selling price of 32, or simply take our fixed costs over the CS ratio. And also, this is what we know. So straightforward. Our fixed cost, we know it was 78,000 divided by a CS ratio of what? 0.40625. Also, 78,000 divided by 0.40625. That is sales of 192,000 Ghana cedis must be generated to break even. So I 7 marks, free Bonto. We didn't do any work. We got 7 marks. Did we do any work? Okay. So they are going to try to enhance profitability, right? They are going to enhance profitability. So due to enhancement of profitability, they are going to do one or two things, right? So there are various options. So they are saying that, okay, first they are going to take option 1. And for option 1, this is what. So I told you anytime something is changing in a question, just look at how it is going to affect your what? Your what? Contribution, right? So they said that what in option 1, if the selling price were reduced by 4 cedis, an increase in demand would utilize 90% of the company's capacity without any additional advertising expenditure. So this is the first one. So option 1, what will happen? What is the new selling price? They said selling price will reduce by how much? Selling price will reduce. So the original selling price was 32, right? They said it will reduce by what? 4 cedis. So what's the new selling price now?
28.
28.
Now we'll sell it at 28, right? And this 28, that means it will affect our contribution. So what's our new contribution now? You see how I do it? Always check whether it affects contribution. So now it's going to be 28 minus our variable cost, which was 19, right? So that means 28 minus 19. That means now our new contribution is going to be what? 9 cedis per what? Per unit. Do you all follow? Okay. But then what is the new volume? What is the new unit we are going to sell? They said now we are going to utilize 90% of our capacity, which is 90% of our original capacity, which is 12,000. You see, getting the 100% helps. It makes everything smooth. So 0.9 times the 12,000, that means we have 10,800 units to sell. Did fixed costs change or fixed costs remain the same?
Remained the same.
It remained the same. So no change in fixed costs, right? So all you have to do is that if you get this one, you lay out your details like this, right? And check what will happen. So we've got a new contribution, we've got a new what way, and then our fixed costs will still be equal to what? The same 78,000. No change. So every time, just lay your variables down so that when they say compute a profit statement, you already know your variables straightforward, right? Straight. So assuming I'm asked to find what? They said statement showing the effect of the three alternative compared to the original budget. I can easily do it, right? So the original budget, I had a total profit of 39,000. Let's see profit statement for option 1, right? So what's our profit statement for option 1? Profit statement for option 1. What will happen under option 1? So profit, I just want you to start with contribution, right? So what's our total contribution now? You know that our contribution was now what? 9 cedis per unit, right? Just multiply by the total number of units we are selling now, which is 10,800. What becomes our total contribution? That's 9 by 10,800. Not so.
97,200.
97,200. Then we less what? Fixed cost. We know contribution minus fixed cost must give us profit. Fixed cost didn't change, still 78,000 also. So deduct it. 78,000. That is 19,200 also, which is our net profit under option 1. Comparing to the original budget, the original budget, we made net profit of 39,000, right? So this one is lower. So let's try option 2 too. You see how we do this? These are the type of questions they now like bringing. Always there's something different, right? So option 2, what happened? Let's lay down our variables. Option 2, what did they say? They said to attract demand, to utilize full capacity, will require a 15% reduction in the current selling price, right? So what's our new selling price? Anytime you hear something reducing or decreasing, right? Just take that cash flow times 1 minus the reduction, right? If they say increase or grow, okay, just take the cash flow times what? 1 plus the rate. It makes it easier. So this, since it's a reduction by 15%, it's like a discount. It means you are left with what? Only 85% of it, right? So the original selling price was what? 32 cedis, and it is reducing by what? 15%. It means that I'm only left with 85% of it. True or false? True or false? Yes. Let's use this approach. Some people to say 32 minus 15% of 32. It's still the same. So, but this one is quicker by 0.85. It means our new selling price will now be what? 27 cedis, 20 pesos, right? Per unit. But once selling price is affected, would it affect contribution?
Yes.
Yes. In addition, we'll have to spend 5,000 on a special advertising program. Okay. So our new contribution is going to be what? 27 cedis, 20 pesos minus what? Our variable cost of 19 cedis. So what's our new contribution?
8 cedis, 20 pesos.
8 cedis, 20 pesos per unit. Okay. And then did something happen to our fixed cost? What's our new fixed cost? They said what? We will utilize full capacity, right? Meaning that here, the unit sold will be what? 100%, right? Which is equivalent to what? The 12,000 units. Not so. Full capacity. So the new fixed cost, they said what? We'll have to spend additional 5,000 on a special advertising campaign. So we'll have 70, original 78,000 plus the special campaign, right? The additional 5,000 for the special campaign. Do you understand? So what's our new fixed cost now? 78,000 plus 5.
83,000.
That means our new fixed cost is now going to be 83,000, right? So this option, we've got our dates. So what's our profit statement or operating statement for this one? Option 2. So for option 2, let's see. So what's our total contribution? Some people like starting with selling price, but it's a waste of time, right? Since you have the detail, just start with your contribution. So our contribution per unit is now what? 8 cedis, 20 pesos, right? And we're producing 12,000 units. Not so. So 8.2 times 12,000. That's 8,400. Then we less our fixed cost. Now our fixed cost is how much? 83,000.
83,000.
Okay, so what's our net profit?
15,400.
15,400.
400.
This one too. I think that this one is even better, right?
Yeah.
One is even better than option 2, but they are all less than the what? The actual budget. Okay, let's go to
Option 1 is 19,000.
yes, that was 19. This is 15. So option 1 is better, but we are comparing all to the
Yeah.
original budget, whether we should maintain the original budget or go with the options, right? What about option 3? So they said to attract sufficient demand to utilize full capacity without changing the selling price, we have to spend additional 35,000 on special advertising campaign. So it means that it is only the fixed costs that change, right?
Yeah.
So new fixed costs, we already have 78,000, right? Then we increase what? 35,000 additional, right? For campaign. So 78,000 plus 35,000. That means our new fixed cost is going to be 113,000, right? Okay, but then our sales volume, how much are we going to sell? They said utilize full capacity, meaning we'll still sell 12,000 units, not so 100% capacity. Okay, but selling price variable cost didn't change, so our contribution per unit still becomes the same, not so, which is 32 cedis minus what? 19 cedis, not so, giving us contribution of 13 cedis per unit. Okay, so in that case, let's get our profit statement for option 3. Okay, so for option 3, what's our contribution? That's 13 cedis per unit times 12,000 units, right? No, so
Yes.
13 cedis by 12,000 units. And that gives us 13 by 12,000. That's 156,000, okay? And then we less fixed costs. How much is the fixed cost now? 113,000. Yes. Oh, what's our net profit?
43,000.
43,000, right? So comparing all the options, let's see. So choice, let's compare all the options. So existing or original budget, what was the profit? Original budget, not profit in anything. 39,000 also. Option 1. Option 1, the profit was how much?
19,200.
200.
19,200.
19,200. 19,200. Option 2.
15,400.
Option 3.
43,000.
43,000. So which one do we choose?
43,000. Option 3.
Go with option 3, right? To produce at full capacity and do more advert, right?